Welcome back, ladies and gentlemen. And today it's a lesson, the holy grail of trading, the risk to reward relationship. This is one of the most important, if not the most important topics in trading. No one is talking about this because they don't know about it, right? Because they think that trading is all about just buying correctly, just hodling and holding forever, and so on and so forth. That is absolutely not the case. Yes, you can do DCA successfully. Yes, you can be a real investor successfully, but it's a very different mindset, huge different mindset. We are talking about trading. This is a trading channel, right? And that is why, as a trader, you need to think like a trader and you need to act like a trader. And as traders, the holy grail of trading is the risk to reward relationship, right? Let's dive right into it, okay? So right now you see a line. This is the buy point, right? Now, above the buy point, you have infinity. Why infinity? Because above the buy point, a coin can supposedly go up to infinity, right? As a matter of fact, usually they don't, right? But let's say you have infinity on one side and you have zero, absolute zero on the other side. So if a coin goes all the way down, it can go to zero, like probably 90 something percent of all projects will go eventually to zero. That's the probability, right? Now, what I want to illustrate here is that from the buy point, what can happen, okay, in an aspect of the percentage of your wins, all right? The percentage of your wins, I will refer to as batting average, just like in baseball, all right? And to illustrate, let's say we have a 50% to 50% batting average, right? So 50% I'm right, all right? And we're talking about longs right now. And 50% I'm a loser, right? So let's say 50% of the times I do the buying point, they go up, all right? And 50% they go to the downside and I lose, right? This is very important to understand. This is the batting average. Again, 50-50. So 50% of the time I'm right, 50% of the time I am wrong. Now, why this is important? Because I want to make sure that when I take profits, as you can see these dotted lines, when I take profit versus where I take losses, there is a difference. Now, let's say I would take 5% over here loss, and I will take 5% wins as well. What I think is going to be the overall performance, right? So if I'm right 50% of the time, right, and I take 5%, let's say out of 100, that's 5, and I lose 50%, all right, and it's 5% loss, it's another out of 100, that's another 5. So they just pay for another. So in retrospect, if I look backwards on my performance, what did I make? I made nothing, right? I made nothing. So when I have a 50% or a batting average, I want the risk to reward ratio to be just above 1-to-1, right? Just above 1-to-1 to be a bit successful, right? Doesn't mean you're going to make huge monies. You're just going to be a bit successful. The bigger you are from 1-to-1, let's say 2-to-1, all right, or 3-to-1 or 4-to-1, the more gains you are going to make, right? Now, I would say that a place to be at or to aspire to be at is a 2, all right, or a 3-to-1 ratio, right? Here I illustrated 50% gains, all right, and 5% losses. But, sorry, yes, 50% gains and 5% losses, and the batting average is still 50-50, right? So over here, if I had $100, I would make 15%, right? And over here, if I lost out of $100, I would lose 5%. Again, once I'm 50% right, 50% I'm a loser. So let's illustrate it with a coin, right? You know that coin tossing is always a 50-50% chance, right? So let's say you would get, all right, you would be 70%, all right? You will get 70 cents when you're right, and you will lose 30 cents only when you are a loser, right? That's the same ratio, 15-5, that's 3-to-1. So same ratios, right? 3-to-1 overall, right? So you would want to toss that coin as much as possible. That is your edge, right? And because you have 50-50 batting average and your risk to reward relationship is 15-5, so 3-to-1, you would just want to toss that coin as much as possible. Now, even if I go down, which is more realistic, right? Even more realistic, you can see that same risk to reward, 15-5, 3-to-1, but the batting average is now 40% only correct, but 60% I am not correct, right? This is still a 2-to-1 trader. We adjusted to batting average. How you do it? You multiply 15 with 40, right? That's around 600, that's 600. And you divide it by what you get from 5 multiplied 6, that's 300, right? 660, sorry. So that's 300. So 600 divided 300, that's 2-to-1, right? So your average performance adjusted to your batting average will still be a 2-to-1 trader. You still want to, all right, toss that coin as much as possible, because in the long run, you will be a consistent winner and you will make a lot of money. A lot of money, guys, a lot of money just by understanding these figures, these numbers, right? Now, the key is consistently throughout time, right? Consistently and throughout time. Now, the goal is not to make the biggest gain per trade, right? No, the goal is to compound the edge, right? The edge, like tossing a coin, that is the goal, not to make biggest gain per trade. And I will tell you why, because the opportunity cost, right? Let's say you have one trade, you made 100% out of it. Perfect, right? That's 100% you made on the trade. Perfect. Let's see something else. Let's say you had 4 trades, you made 20% per trade. You compounded it. How much? That's 107% gain, right? That's more than just 100, right? Let's say you had 8 trades. You made 10% compounded per trade. That's 114% per trade, per compounded performance, right? So what's easier? Just 100%, 20%, so 10%. I would say this is the easiest, right? Right? But sometimes that's not the best edge to compound, even though it looks like it right now. However, what I'm trying to say is that if you will wait always for the 100, all right, 100% gains, it will opportunity cost, because you can make 420s or 810s almost every day. Almost every day. So, bottom line, right? Bottom line, you want to compound the edge. You want to understand your batting average, and you want to understand your risk to reward relationship. All right, ladies and gents, I hope this is understandable and you get it, because it took me, well, to be honest, it took me a few years to get and understand this. But once I did, once I understood that trading is not about buying, right? It's not about figuring out which coin is going to be the next big coin, right? Trading is about compounding my edge. And my edge is, all right, having a batting average of around 40% right, let's say even 35% right, but having my reward at least 2 to 5 to 3 times my risk, all right, at all times, always thinking about it, always, all right, understanding the opportunity cost if I'm waiting only for that 100% trade. And to be honest, I would be scared shitless to put all my capital on one trade that will probably not make 100% and have a big chance, at least 60 or 30 or 65% chance of losing, all right? And if you don't use stops, that's painful. That is painful. All right, ladies and gents, if you like this, all right, and you have questions about this, first of all, like and subscribe. That's from me. Second of all, put your questions and your thought in the comments below, because that is important. And if you really want to hone your skills and you really want to understand the way I trade and you want to see the way I trade in real time, you can go over to my group, over my Patreon. That's the link in the description. You know, for less than $20 a month, for less than one hamburger a month, you can see exactly what I do and learn from what I do. I think that's a risk worth taking. All right, see ya, cheers, and stay tight.